This video is for educational and informational purposes only. Mutual funds and stocks talked in this video are purely used as examples. This video is not meant for advisory or recommendation purpose.
Hi, my name is Swati and you're watching aliceblue online YouTube channel. Did you know a bear market could happen when stock prices fall about 20% from their recent highs, whereas a bull market happens when stock prices rise about 20% from the recent lows? Well, that was just to give you an idea of what is what. To understand the topic clearly, watch the complete video as I will be talking about what are bull and bear markets, what is a bull market, what is a bear market, and the differences between bear and bull markets. So, what is a bull market? To a layman, a bullish market essentially represents optimism in the securities market, that is, positive end result. The myth around the term bull is that it is a metaphor for the upward trend in the market. As you can see in the image, for example, the bull attacked by tossing his horns upwards. However, this is not the only explanation behind why it is called a bull, but is the most popular belief. In statistical terms, a market is best described to be bullish when the stock prices have increased 20% or more. The market can be bullish for a lot of reasons, such as macroeconomic indicators, that is the growth of gross domestic product or the GDP, sometimes lower unemployment rate, and etc. But it is largely the investor confidence and optimism in the market that leads to a bullish rally. A bull market could last anywhere from a few months to even a few years. It is, however, difficult to foresee exactly when the bull market could possibly start or if it really aligns with the macroeconomic indicators. For example, a couple of months after the COVID-19 crash in the market in March 2020, stock prices started to go up. It took a little time, over 9 months, for the benchmark indices Sensex and Nifty to double their levels since the COVID crash. And one of the best examples is going back to scam 1992. Mr. Harshad Mehta engineered one of the most successful bull runs in the history of the BSE in 1992, as he siphoned funds from many state-owned banks. The market eventually crashed when its biggest titan was busted for fraud. Similarly, in the US, the dot-com bubble towards the turn of the century also led to one of the most successful bull runs, not only in the US markets, but also in the Indian markets. And one of the obvious things that investors do in a bull market is to buy securities and hold on to them until they sell them for a sizable profit. However, this not only requires the intuition to know when the market will hit rock bottom before ascending, but also confidence within the investor, who believes that the price will only ascend. So always take it with a pinch of salt if a bull market lasts longer and does not really reflect the truest economic picture. So now that we know what is a bull market, let's also know what is a bear market. A bear market is diametrically opposite to a bull market. When trade prices fall about 20% from their recent highs, the market is said to be bearish. It represents pessimism, that is the negative end, and overall dipping of investor confidence in the market. Like a bull, the term is believed to be coined by how a bear hits his claws in the downward direction. This is a metaphor for the decreasing stock prices. The bear market is indicative of the decline of the overall market in general. Stock indices such as the Sensex or the Nifty will erase their gains. Usually, the price of any stock is a sign of how a company will perform in the future, in its bare bones, whether it will make more money or not. Economic downturns such as unfavorable fiscal policies or a recession can also trigger a fall in prices. The outbreak of COVID-19 led to one of the most unpredictable and sudden onsets of bear runs in history in March. However, the markets recovered quickly. The Sensex hit its all-time high of 52,516.76 on February 16, 2021. It has been on a downtrend. If it shaves off 20% from its peak, we will enter a bearish phase. In the past, the global recession that was triggered by the collapse of Lehman Brothers in the US led to a very long bearish run in the global markets, including India. So now that we know both the markets, let's find the difference. A bear market could happen when stock prices fall about 20% from their recent highs, whereas a bull market happens when stock prices rise about 20% from their recent lows. A bear market represents pessimism in the market and a dip in investor confidence. A bull market represents optimism and rising investor confidence. Usually, unfavorable economic policies or events such as a recession are the reason for a bear market. A bull market, on the other hand, happens when there is optimism in the market, such as lower jobless numbers, growing GDP. Most investors usually buy early in a bull market and hold on to securities until they reach a much higher price. Whereas in a bear market, it is best to sell holdings and move on to a safer havens. I hope that you are clear about the topic. Thank you so much for watching this video, and I will see you in the next one. Bye-bye.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.